The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
That caution around geopolitical and economic risk keeping markets on the back foot on this Thursday afternoon. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. on this Thursday. We've been seeing fairly muted moves in the S&P 500 all session long. Investors remaining on edge on the conflict in the Middle East, awaiting for Israel's response, its retaliation against Iran. Treasuries declining. We're at session lows for the 10-year. The yield getting pushed up almost by 7 basis points at 3.84%. It's at a 1-month high, I should say, the 10-year yield overall. Now, NYMEX crude up 5.3% right now, approaching $74 a barrel. When asked whether the U.S. would support Israel striking Iran's oil facilities, President Joe Biden said, "We're discussing that." Dollar strength continues. Today, it is the pound getting hit. It's weaker against all 16 major currencies on dovish remarks from the Bank of England Governor Andrew Bailey. Romaine?
All right, let's jump right into it here, because based on the price action for the past 3 days here, anything is certain, and the only thing is certain is that struggle for direction in equities will continue until there is some semblance of a tamp down in those Middle East tensions. No reprieve today. Israeli bombs are raining down on Lebanon. U.S. President Joe Biden stumbling when answering a question about potential attacks on Iranian oil facilities, a hypothetical I posed to Rebecca Babin at CIBC just yesterday.
There is some speculation that maybe Israel goes after one of Iran's refineries that primarily produces gasoline for domestic consumption, meaning you don't necessarily see a huge amount of their exports impacted as a result of that. It's more of an internal domestic issue. So there's a lot of different ways to slice this, but I think to get to your big picture question is, have we priced in everything if they do target energy infrastructure? No. I think you see another $5 easy on the top of where we are.
Well, we didn't exactly get that $5 today, but we did get 3 on both Brent and NYMEX crude. Citigroup right now estimating that a major strike on Iran's export capacity could knock out about 1.5 million barrels of daily supply, and even a minor strike on downstream assets would knock out about 300,000 barrels. The dollar gaining for a 4th day here, and that's bolstered by a 2nd day of rising Treasury yields. And let's talk about those yields, because those elevated yields early this morning went even higher around 10 a.m. This after that ISM data showed that the services industry continued to expand at the fastest pace in at least a year and a half. A hotter than expected reading that suggests a hotter than modeled economy, that suggests maybe hotter than justified expectations for Fed rate cuts. And unless tomorrow's monthly jobs report is really weak, Scarlett Fu, then Treasury traders might find out, Treasury bulls, I should say, that they're on the wrong side of history right now.
Right. It wouldn't be the first time either. All right. So in addition to that services data that you just mentioned, we also got a read on weekly jobless claims today, which showed that 6,000 more people filed claims for unemployment benefits. The total print of 225,000, that's the bar here at the far right, is slightly higher than what economists expected. But the 4-week average of new claims, and that is the green line, fell to a 4-month low. So big picture, layoffs remain relatively low. Now, for tomorrow's jobs report, economists expect an increase of 150,000 jobs in September. The range of estimates is really wide, from a low of 70,000 to a high of 220,000. The jobless rate will likely hold at 4.2%, and wages probably rose 3.8% versus last year, but slowed to 0.3% from a month ago. Romaine?
All right. Well, this is, of course, going to be the first of 2 monthly jobs reports that we get prior to the next Fed meeting, and people are already positioning around it. Stephanie Larosiliere joining us right now, head of fixed income business strategy and development over at Invesco. Kicking us off to the close today, and let's start off with that jobs report, Stephanie, and how much we should read into the potential for a miss on those numbers we just had on the screen.
Yeah, I think, when we look at what the Fed is paying attention to, it's certainly going to be the jobs report, and it's certainly going to be, where that trends. So I don't think we can overemphasize it. I think right now the Fed is going to continue to be data dependent, as they have been. However, the data shifted, as we've all seen, from inflation to now, employment numbers. And so we do think that tomorrow's jobs report will be a key factor in determining forward-looking guidance from the Fed.
When you look at the data that we've gotten so far, and if you look at some of the estimates for what we might get tomorrow, tomorrow, Stephanie. Does it feel like yields right now in the Treasury space are priced appropriately for the amount of rate cuts that we might get?
It feels like we're a little bit more aggressive than we need to be right now in the Treasury market. Here, our economists are calling for 2 more rate cuts, about 4 next year. We're actually calling for about 1 rate cut every other meeting for next year. So we do think that unless something changes significantly, we are likely to stay on that path. I think the market is calling for much more aggressive forms of cuts, which we don't think we'll get to.
It's not so long ago that we had a growth scare. August 5th was not so long ago. Early September also not so long ago. What could that growth scare come in the form as? What might that look like if we do get one?
So I think right now we're in a space where, when it comes to data and what we're seeing come out of the economy, everything is going to be a potential for a scare. I think that everyone is very, very hyper focused on all of the economic data that's coming out. And so, I think something that traditionally may not be a scare right now in this environment could be a scare because the market is really just looking for any cracks in the facade that it can find.
Talk a little bit about demand for treasuries as a safe haven versus, say, gold or anything else. I mean, we know that oil prices have been getting a lift because of fears of disruption to oil supplies, but treasuries have certainly gotten a bid in the wake of the conflict in the Middle East, the renewed conflict.
Yeah, so we do think that, the flight to quality is something that typically does take place. We think that there has been some volatility, in the commodities markets. And right now, it seems like, again, we're going to see a shift back to treasuries as that safe haven asset class if we do continue to see a lot of these geopolitical macro risks in the system.
So when we get to this idea of where we end the year and the idea that everyone's already sort of priced in much more aggressive targets for year-end market performance, and for that matter, to a certain degree, slightly more aggressive targets heading into 2025. Are you in a position, Stephanie, you and your team over there at Invesco, to start sort of going out on that limb for 2025, or do you want to wait to see just what we learned from the Fed in November and beyond?
I think you have to be prudent in this environment, right? So we're looking at all of the credit fundamentals. We're looking at the underlying idiosyncrasies in various parts of the market. But you have to pay attention to what's taking place and what the rhetoric is that's coming out of the Fed. So while I think, all of the data points we're looking at make us feel good, we think, the market is primed for investment. The market is primed for investors looking out, getting away from those treasury bills and now looking at the intermediate part of the curve, low default rates, strong yields. But we would be remiss if we didn't pay attention to what the Fed is doing as well.
How many people, though, I mean, and particularly I'm talking about your clients, are really willing to sort of, I guess, let go of that 4 or 5, maybe even some cases close to 6% on the short end, extend duration now? Because you're still seeing, at least in money markets, you're still seeing record levels there. And even in other parts of the shorter end of the curve, based on CFTC data, you're still seeing a lot of people crowded there.
We are still seeing quite a bit of investment in that front part of the curve in treasury bills and money market funds. But we are starting to see record inflows into intermediate funds, the 3 to 10 year part of the curve. You look at the long end of the muni market. The muni market's gotten now 38 trading days, I should say, of consecutive inflows into that part of the market. So we are seeing a lot of investors that have had some pent up demand sitting in cash and don't want to pay the opportunity cost if they stay too long.
Okay, so we're seeing that demand for short-term debt in treasuries, in munis. What about for corporate credit? Where do you want to be? How do you want to be positioned given where the economy stands right now?
Yeah, we think that right now is a time where we actually believe that the tail risk, the Fed has sort of taken some of the tail risks out of the equation. And with that, we think high beta strategies are the way to go. So, when we look at the corporate space, we do like, down in quality. We do like the high yield portion of the market. We've got an active ETF, GTO, that is taking advantage of some of that right now.
Stephanie, always a great conversation. Stephanie Larosiliere there, head of fixed income business strategy and development at Invesco, kicking us off to the close here on this Thursday afternoon as we keep an eye on stocks and keep an eye on bonds, but we also have to keep an eye on what's been going on in the FX space. The pound getting pounded and the yen carry trade getting a new shot at life. A look at some of the biggest moves in the foreign exchange market when we come back.
Of course, we're also following major moves in oil, with West Texas Intermediate bubbling up 5.5% today alone. I guess one question is if and when WTI crude can hit $100 a barrel.
And another big story on the day is those GLP-1 drugs, and more importantly, those generics that had a very strange exemption for the last few months. That exemption might be over. Hims and Hers, one of those stocks, really taking a hit on the day. That conversation and so much more coming up in a bit. This is The Close on Bloomberg.
The worst performing major currency today is sterling. It is down more than 1% against both the euro and the yen, its biggest slide in over a year. Bank of England Governor Andrew Bailey suggested the central bank could take a more aggressive approach to lowering interest rates. And with so much happening in the geopolitical space, there's a lot to cover in FX. Let's bring in Mark McCormick. He is Managing Director and Global Head of FX and EM Strategy over at TD Securities. Mark, I think we got something like 25 rate cuts in the month of September, and we also ended that month with the China stimulus package to boot. If reflation is actually back, what does that mean for the U.S. dollar?
Well, I think it's very interesting because the market is very fixated on this reflation narrative, which you could probably see is priced into the credit markets and the equity markets. Those markets are doing quite well. They're saying that risk is on, things are fine. Bond markets basically pricing in a recession. Geopolitical risks are on the rise. There's a lot of uncertainty, and volatility has been pretty much subdued since the carry trade implosion earlier in the summer. So I think what's interesting is whatever you think the theme is and however you want to trade it, that's the one you're going to kind of push the most. I think what's very interesting about this year in general is we are not seeing a very specific macro trend, which kind of keeps us focusing on different themes: soft landing, hard landing, no landing. So I think the market believes reflation is the theme to be a part of right now. But I think this is going to be challenged by what we're looking at is in terms of market positioning swung in really strong direction, which is short the dollar, which is expecting a lot of Fed cuts. And I think we're moving to the other side now, which is we should start to focus on before China re-stimulates its economy, its data is going to get worse. The data in Europe is getting worse. We're starting to see more aggressive move by European central banks. And all of this is starting to reverse that pendulum back in favor of the dollar.
Okay, and of course you also have Middle East tensions leading to this flight of safety and money moving into the dollar as well. How much of a boost does that give the dollar, independent of all the macro factors you just discussed?
I think the easiest way to think about it is when positioning is one-sided and a market narrative is kind of focused on one thing, you don't really need a strong shock to change us out of that environment, to change the regime, essentially. So I think basically what's happened is that after the carry trade, the macro volatility indicators we track basically went to like risk-loving, risk-on type of environment. But we had geopolitical uncertainty. We also had a rise in cross-asset market stress, those kind of indicators that we track. So for me, what we're kind of seeing is that there's a disconnection between fixed income, FX, and equity vol versus the other indicators that are telling us that volatility should be a lot higher. So I think what's interesting is what we're seeing is that the market's positioned one way, they kind of believe in one story, and now it's being easily disrupted by any number of factors: the dock strikes, the Middle East tensions, stronger U.S. data, again, the move that we're seeing in European central banks. Any of these things are catalysts. So I think the Middle East tensions are very big because, again, the one thing the market seems to have totally forgotten about or just doesn't care much about is inflation. Central banks are easing, and we're kind of moving to that environment, which is reflationary. But they're moving at a time when their inflation levels are above their target, which makes this also a very challenging space to start cutting interest rates.
It's also interesting, too, though, Mark, and you touched on this idea here of what we see in the FX space, in the fixed income space, in the commodity space, and for that matter, in the equity space. And I am curious about the correlations there, because as you said, I mean, some of those markets are basically signaling completely different things.
Exactly. Yeah, I think they are. And the number one question that we keep getting, and it's not like kind of a very exciting indicator, but they're like, where's market positioning? That's what clients want to know. Clients aren't asking questions about the next 6 months and next 12 months. They're really dialed into the very short term. And I would express that as a simple illustration of we run these different quantitative portfolios. We call them factors. But the most interesting thing that's happened in FX this year is mean reversion, underscored by positioning and short-term valuations. are the best performing strategies in FX. It's not a growth strategy. It's not an inflation strategy. Carry has underperformed. So the interesting part is that positioning has moved into such a direction where our indicators are max short the dollar, the largest we've seen in 6 months, which to me, again, you get the stronger data, you get any volatility, the dollar's the place to go. And this is also why I don't think, the movements in the yen is not really about a carry trade today.
No, it's not. But I am curious. I mean, just on that last point then, so is your recommendation, or at least is your house view right now, is to bet on the dollar, at least relative to the pound, for example, today, or the euro? Is that the base case?
Yeah, we're bullish the dollar. We have this expressed through short New Zealand dollar, which is a very high beta currency, which means, if we have more volatility, New Zealand's going to sell off the most. We're also short euro through put option, through essentially through an option structure, which allows us to get us through the election. The other big elephant in the room, which is the U.S. election, which has very big implications for the U.S. dollar.
Yeah, I almost forgot about that. All right.
32, want to forget about
32 days and counting. Mark McCormick, Managing Director, Global Head of FX and EM Strategy over at TD Securities. A lot of activity in the FX space today, but when we come back, we're going to turn back to equities and to GE Vernova. Investors are using the AI boom to pour money into that stock, but Raymond James says the rally might be a bit overstretched. We're going to hear from that analyst in our top calls up next, right here on Bloomberg. All right, let's get a view from the sell side with our top calls. The big movers on the back of analyst recommendations. And we start off today with the insurance and wealth management company Voya. Cut to neutral over at JP Morgan. The analyst citing lackluster near-term business trends and says that the company's earnings have been of poorer quality given margins in the medical stop-loss business and net outflows in the retirement and asset management divisions. Those shares down about 1% on the day. Let's take a look next here at EVgo Supercharge, thanks to an upgrade to overweight. This over at JP Morgan, which said EV charging companies that own and operate their own infrastructure will do better than others. The upgrade came just a few hours before we learned the U.S. Energy Department had agreed to a conditional $1 billion loan commitment to aid the nationwide expansion of U.S. charging infrastructure. EVgo shares having a great day, up 59%. And finally, let's take a look at Wolfspeed. A speed bump today as Mizuho downgrades to underperform the shares of the chip and circuit maker whose products largely are used in automobiles. Analyst Vijay Rakesh citing slower global EV sales this year that will carry over into the next, exacerbated by cooling demand in the industrial and energy sectors. Wolfspeed shares taking a leg down 7% on the day, and those are some of our top calls. We do want to take a look here at another big mover, not necessarily on the day, but certainly on the year. In fact, the fifth best performer in the S&P 500 in 2024, GE Vernova. Shares up nearly 80% since spinning off from GE back in April, and that's thanks in large part to the promise of AI. But analysts over at Raymond James are telling investors that the stock maybe could use some consolidation. Pavel Molchanov joining us right now, Managing Director and Equity Research Analyst at Raymond James. He just cut his rating on GE Vernova to market perform from outperform. All right, let's start with the valuation here. I mean, this is a stock that really came out the gate fast and furious after that spinoff. It's been on a tear ever since here. Is there any sense here that investors might be onto something having bid this stock up so much?
Well, they're certainly onto something, and the trade is crowded precisely because there is so much awareness in the market about the AI data center boom and the electric power build out that is supporting that boom. So Vernova, as the proverbial supermarket for electric power infrastructure, gas turbines, wind turbines, transmission networks, it's in a great position to benefit from all of these demand trends in the electricity market. But at 45 times earnings, I would argue it's pretty well baked in at this point.
I guess the question then becomes, and I understand that 45 times earnings in isolation is certainly rich, particularly for what is effectively a power company. But when you compare it to peers or you compare it to other companies that could also potentially benefit from the AI power boom, is there a relative case to be made that that valuation isn't that bad?
Well, Vernova has a certain scarcity value as a stock because it is certainly within the S&P 500, the most directly kind of related company, setting aside utilities, for the electric power infrastructure build out. Now, it's not a monopoly. There are companies that also make a lot of the same equipment and provide some of the services that Vernova does. But they tend to be traded internationally. So, for example, Siemens Energy on the Frankfurt Exchange, and there are some Chinese stocks that do similar things. So Vernova for U.S. investors is pretty much their best option, and that's one of the reasons why it's been bid up, as you saw, almost double in 6 months.
Clearly, there's a lot of excitement over the promise of AI. What is the reality when it comes down to what the company has said about how much it stands to benefit from this AI boom?
So U.S. electricity consumption, let's just kind of zoom out, has been growing for the last 20 years at barely 0.5% per year. Through 2030, our view is it will be growing between 2 and 3%. So, not huge, but certainly much better than what we've had for the last quarter century. And Vernova, as again, not a monopoly, but one of the players, is directly levered to this theme. However, keep in mind, very multinational company, 63% of its sales are outside the U.S. Right. So when we look at Europe, when we look at places like Brazil, AI is not really the demand driver there. There are other aspects of electric power that are more interesting, more relevant there. But AI is much more of a U.S. story, and indeed, predominantly an East Coast story.
Ah, gotcha. Okay, so this downgrade sounds like it's more tactical than it is fundamentally driven. Would that be fair to say?
Exactly. A great company. There are announcements that we'll get later this year, 2025 guidance. We'll get a dividend announcement. But again, I just think, at a PE of 45 for essentially a large cap kind of heavy industrial story, it's pretty well baked in.
Okay, Pavel Molchanov over at Raymond James. Thank you so much for joining us today. And of course, he just downgraded GE Vernova to market perform from outperform. Not the first utility-linked kind of company that has gotten a little bit overstretched based on AI hype.
But everything's overstretched. I mean, when we get the inevitable OpenAI IPO, I can assure you it's going to be priced at more than 45 bucks times earnings. But it gets to this idea, though, and he kind of was treading that line of not calling it a monopoly, but it kind of is. At best, maybe it's worse, it's a duopoly, and that gives it a a lot of pricing power. GE Vernova.
And I mean, in terms of what U.S. investors can look at, it's an attractive option as opposed to some of the other names out there. All right, coming up, we're watching oil prices amid all this geopolitical turmoil. We're going to speak with Frank Monkam. He is Senior Portfolio Manager at Antimo for his outlook on commodities. This is The Close.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. And of course, we're keeping a very close eye on commodities, given all the tensions in the Middle East and everyone awaiting for Israel's response to retaliate against the Iran attacks. You could see Brent crude up 5.25%. I think WTI is up a little bit more than that. And of course, the other big story, Romaine, is the China stimulus. Copper's taking a bit of a breather today, as is all the China-related trades. But that's been a big, big boon for all the commodities.
Yeah, absolutely there.
Okay, here in studio with more on this is Frank Monkam. He is Senior Portfolio Manager at Antimo. And Frank, we want to really get your take here on commodities, starting with oil. You look at WTI, it's just under $74 a barrel. It's still a long way off from where it was at the beginning of July, which was at about $80 a barrel. What's the next stop here for oil as we continue to wait for what's happening in the Middle East to play out?
Yeah, sure. Thanks for having me today, guys. I just kind of want to level set things a little bit by kind of highlighting, the macro setup with which we're trading right now. The month of September was one of the most dovish, sort of coordinated central policy shifts. 21 cuts in September alone. That's the most cuts we've seen since COVID. And what that's doing really is this shift in the tide, really, right? The policy put us back So it's putting a fuel under all these risk assets, including commodities. Now, the question is, people look at the price action in oil and wondering what's happening. Obviously, why is the market not up, $10 or more, given the risk of, the energy facilities getting hit? And I think the question, the answer behind that really is the fact that you had a perfect setup, really, for short squeeze to happen, right? You have a policy put from the U.S., from China, monetary policy, fiscal policy behind it. But then when you look at the way that the market has been so short, right? Yeah. I mean, this is kind of the perfect storm for a market to snap back up. So I think what's happening is really not so much the market thinking that we're going to roof here, probably going to $100. It's more. It's probably 70% short covering, and 30% really people buying the upside, thinking we're going to roof to 85.
But I'm curious. So are we actually seeing though an actual real unwind of shorts? Because I mean, I feel like that would have precipitated a much bigger move if you really had everyone bailing, rather than just the $6 or $7 we've had over the last few days.
That's actually a good question, right? I mean, the way that the market has been, the price action that we've seen in the market, really, a lot of it has been shorts getting unwind, Sorry, but at the end of the day, what happens when you have these kinds of moves is you got to hit some gamma gaps in the market for really these crazy moves to happen. And these gamma gaps are probably $5 to $7 away, so we haven't really hit those. Mm-hmm. So you see some short unwinds, but not in a crazy fashion.
But is that more tactical? Because I mean, the long-term issues that led to those shorts are still there.
Yes.
And in theory, I mean, you knock on wood, what's going on in the Middle East potentially could be resolved.
Yes, exactly. Yeah. So the way that I describe the way market at the moment, it's a market that's kind of thematically unanchored. Meaning there's no real theme behind oil at the moment. I mean, you have a theme behind copper with the AI story. You have a theme behind gold with central banks buying, et cetera. But oil right now doesn't really have a secular theme. And cyclically, it's a market that's bearish, right? I mean, OPEC is looking to release. We've got anywhere from 500,000 to 1 million barrels of surplus next year. But tactically, in the shorter term, it is bullish, right? Because of the stimulus that's coming in, the market being short, and obviously the situation in the Middle East. But secularly, it's a market that's bearish, and it's probably looking like we might set up for, especially if things were to calm down in the Middle East, for a kind of a better entry point for shorts going forward.
So speaking of stimulus, what about China and the reflation story there as a theme? How much are you going to see that across the commodities complex? Because it's lifted copper a little bit here, but not today, for instance.
Yeah, I mean, it's going to be very differentiated, right? I mean, every time you get this kind of stimulus in China, I mean, if you look at the sequence with which this stimulus kind of took place, it was initially monetary, then fiscal, right? The fiscal tends to have more of an impact on crude oil because it's money straight into the consumer's pockets, whereas the monetary stimulus gets directly correlated to the copper market and to metals. But I think if you really look at what's going on in China, and you step back, and once the dust kind of settles around this, it seems like it's more of an equity story, right, with this stimulus, because the rates market in China actually isn't buying that. If you look at the local rates market, the 5-year OIS in China, it's still hovering around 2%. I mean, there's a pretty nice chart to look at, basically, where you see the short squeeze on Chinese equities versus the OIS, which would have basically exploded if people really believed that these measures were going to be fully implemented and eventually even bring in some inflation to the market.
But a lot of people are chasing that trade right now. Are you one of them?
Well, I think it's a trade that's hard to chase, because when you have moves like these where the Hang Seng right now is trading about 30% of its 200-day moving average, that's really rare. Yeah. I think we're probably due for a pullback. I mean, we've seen that a little bit today. Yeah. But I think there's probably a couple more waves of this, because asset managers are so underweight China at the moment that there's a major risk of a flat squeeze. And even to add to that and to kind of connect that with the U.S. equity story, I think there could be a situation here where you've seen a rotation away from U.S. equities trading at all-time high, and the S&P at 22 PE versus the Chinese stock market at 10 PE, where people kind of rotate away into China to kind of make sure that they don't, they're not facing a flat squeeze.
Investors are underweight China, or they're not even have a weighting in China. They're just not exposed to China at all.
Well, asset managers for the most part are underweight China at the moment. Hedge funds have been short. They've been covering shorts recently, but the asset management pocket of the market is still super underweight, right? So, like I said, the risk of a flat squeeze is immense. And, I think that as the market pulls back off of this crazy, gamma move, I think that there's probably going to give some people some entry points to go back along to make sure that they're not trailing the index by much.
So when China reopens on Tuesday, what do you see happening? Because there's been a lot of news flow since they took off for Golden Week.
Yes. Well, it's hard really to pinpoint how exactly the market is going to open up.
But in terms of sentiment and momentum.
Exactly. I'm getting to that. I mean, the sentiment story really is hard to kind of forecast here because of what's going on in the Middle East, right? What if we wake up on Monday morning and it's been, kind of a pretty hellish situation out in Israel and Iran, right? That's just a totally different story. I think there'll be flight to safety, all across the board. So it's hard to kind of forecast what's going to happen there. But all things being equal, I think that if the market were to open down, anywhere from 2 to 3%, I wouldn't be surprised if you see some buying coming in. I wouldn't call it bargain hunting, but because, like I said, the market is so short and underweight, I think there are people still waiting to get in.
Any sense, if we do see a sort of another bout of buying, do you think that buying is going to primarily be from foreign investors, or do you think we're going to see more domestic activity?
I think both.
Yeah.
I think foreign investors have been, bearish China for a long time.
Yeah.
And China actually made a very shrewd move in the timing with which this stimulus came, because I don't think it's random the fact that all these policies were announced right after the Fed made its move. So I think it's waiting for the Fed to kind of make sure that the Fed wasn't going to make a hawkish move. I think the cut was, obviously 50 bips versus 25. That's pretty dovish.
Yeah.
Even though the presser was slightly hawkish, but on balance, it's a pretty dovish move by the Fed.
Yeah.
So China just came in and added to that to make sure that they would squeeze the shorts out.
All right, Frank, I have to leave it there. Frank Monkam, Senior Portfolio Manager over at Antimo. A closer look here at, of course, the commodities trade as well as that China equity trade. We've already heard from quite a few investors who basically said they're all in on it. Mm-hmm. David Tepper basically saying he's buying anything he can get his hands on. You have a lot of strategists on Wall Street that have now either flipped their recommendations to overweight or have actually shifted their positions altogether. Yeah, not even having to go overweight, but just getting in a little bit, having some exposure has resulted in a big pop in a lot of these asset prices. Yeah, absolutely, Kira. And it'll be interesting to see whether that trade continues into next week when the mainland markets reopen. But of course, what happens here in the U.S. could have a big impact on that as well. We count you down to the closing bells with just about 21 minutes to go, and a look at one of the biggest movers on the day. Hims and Hers down 11% on the back of some concerns about those generic weight loss drugs. This is Bloomberg. All right, it's time now for our stock of the hour and a closer look at Hims and Hers. This is the telehealth company. Its shares scaling down today on news of Eli Lilly's obesity drugs no longer on the FDA's shortage list. This creates more competition for cheaper versions of the weight loss drug. Bloomberg's Jess Benton here to talk a little bit more about this. You see the shares down there, 11%. Let's just wrap this in a nutshell. You had these name brand drugs. There was a shortage of them. An exemption was made by the FDA at the end of 2022 that allowed these compounding pharmacies to effectively make a generic version that hadn't gone through approval. And now you're telling me what? That the rug has been pulled out from under them?
They have.
Yeah.
So basically, they can't manufacture the knockoff type of drugs. And this specifically benefits Eli Lilly. So when you think of either Zepbound or Mounjaro, the obesity or diabetes-related drugs that it manufactures, before, because there was that shortage, Hims and Hers could actually have these types of knockoffs. And even they didn't even necessarily have to have FDA approval to do that. But because now the FDA lifted the ban of basically what was happening with the shortages, they can no longer manufacture that. So you have BMO Capital Markets, they actually have a 1,100 price target on Eli Lilly now. That's basically a 24% upside from where the stock's currently trading right now. But Citi, on the other hand, they're talking about Hims and Hers. It's not necessarily even just what would happen with the latest on this, but also when you think about just the manufacturing capabilities. And a lot of this, it was benefiting the last 2 years from this shortage, even before today's losses. That stock was up over 200%. So
is
that's
this
why
a gendered drug or something? So if I buy from them, I have to get the one that says Hims on it? Or other
drugs are just for him.
Right. But also, this was a company that went public just a few years ago via SPAC, and it really gained popularity and traction, not surprisingly, because of COVID and people going to that. And then it really benefited. That stock was up over 200% before today, just based on what it had benefited the last 2 years.
So I have a question here about these weight loss drugs and the fact that Eli Lilly's version is no longer in shortage. Is that because demand has tapered off, or is that because Eli Lilly has caught up with supply and it's no longer having difficulty manufacturing enough of them?
Right. So now that it can manufacture that, it doesn't have those issues anymore. Now it can start manufacturing it again, but it doesn't help Novo Nordisk as much. If you think of like Wegovy or Ozempic, because those obviously we know are very popular. So basically, Hims and Hers can still manufacture those because the substance is still technically in shortage. So if you look at the U.S. listed ADR for Novo Nordisk, that's why you're seeing that down close to 1%. Eli Lilly came off a bit of the highs earlier today, so now it's down only about 0.7%. But
so
you
what's
initially
the
saw
substance?
that pop.
So it's a different substance.
Yes,
there.
exactly, that they use for when it goes into Wegovy or Ozempic. So their obesity and also
this
weight
is very
loss drugs.
confusing, and to the point of the shortages. I mean, not to sort of throw logs in the fire here, but wasn't this kind of a manufactured shortage? I mean, I mean, look, if Lilly and Novo really wanted to ramp up, they could have. They just didn't want to put up the money.
I think that's really a lot that had to do with it too. And then obviously not just obesity type of drugs, but people trying to use this and gain traction for the weight loss. So basically, when it comes to Hims and Hers, they can't manufacture what's happening with the substance that goes into those types of drugs that Eli uses, but they still can for the ones that Novo Nordisk uses at this point. Yeah.
Right, so choose your weight loss drug carefully. In other words, if you have a choice in the matter. Jess Menton, thank you so much. Bloomberg News reporter Jess Menton covering all of this. And, it feels like we were talking so much about how this was going to affect all the different companies out there. A lot of food companies were worried, but now they seem to have settled down.
Yeah, well, unless, Eli Lilly and Novo Nordisk flood the market with all that stuff they've been holding back on, Scarlet Food.
All right, let's count you down to the closing bells with Ed Clissold, Chief U.S. Strategist at Ned Davis Research. He is next on The Close on Bloomberg.
All of the data points we're looking at make us feel good. We think, the market is primed for investment. The market is primed for investors looking out, getting away from those treasury bills and now looking at the intermediate part of the curve, low default rates, strong yields. But we would be remiss if we didn't pay attention to what the Fed is doing as well.
A market, at least for today, still struggling forward direction. Stephanie Larosiliere over at Invesco kicking us off to the close just about 50 minutes ago, and with 10 minutes until the closing bells, markets really haven't improved at all here. Red across the screen for all the major indices and green across the screen when it comes to the oil market.
Yeah, and really for the past 2 weeks or so, we haven't seen much big moves in the S&P 500. It's closed down or up with less than 1% every single day since September 20th. So we haven't had any sense of conviction over direction here. And
no sense of conviction. I don't know if tomorrow is going to change that. You have a big jobs number coming, but again, when you look at the estimates, is that really, if it hits those estimates, is that going to move the needle? Yeah. If there's a big miss on the upside, does that move the needle? Maybe. To the downside, maybe. I guess investors will have to sort that out. And we should point out, though, volatility is certainly elevated. That's one thing that is certainly consistent over the last few days.
We have seen oil prices continue to rally. That's another thing, as everyone awaits some kind of response from Israel.
56.93 right now and change on the S&P 500, 3.7 on your 2-year yield. The VIX at 20.5. Ed Clissold is the Chief U.S. Strategist over at Ned Davis Research. Ed Clissold joins us right now to help us count down to those closing bells. And Ed, talk a little bit about the price action that we've seen really over the last, 6 or 7 sessions, because it seemed like coming out of that last Fed meeting, there was a lot of euphoria, and then that just kind of flatlined. And I don't know if it was just that all of the upside was priced in maybe heading into that meeting and then maybe the hour or so after, or is this really about a significant sentiment shift given some of the geopolitical developments that have popped up over the last few days?
Well, hi, Romaine. I think it's a little bit of both, particularly with the Fed leaking the 50 basis point cut a few days before. The market managed to price a lot of that in. But after that, the market had to move forward and look ahead. And we have, some earnings estimates that maybe should have been brought down earlier. Now that we're getting, into earnings season, they're happening now. That's part of the news today. And then secondly, you have the first half of October during election years tends to be weak. The race usually tightens up, so there's some anxiety over that, and that certainly seems to be part of it as well. And you throw on some geopolitical tensions, and look, over the long run, these things tend to not have a major impact on the market. There's a knee-jerk reaction, and the market moves forward. But you put those three things together, and yeah, it's a recipe for a market that's struggling for direction.
Well, it gets to this idea too, and I'm glad you bring up some of the historical narratives, because we were talking a lot about, September historically was going to be, one of the worst months for us, and it turned out pretty decent here. And I am curious that now that we're heading into an election cycle where once again everyone's looking at those historical calendars and trying to divine where the market is, I mean, for lack of a better phrase, is this time different, Ed?
Well, yeah, when you're talking about averages with these election cycles, there's plenty of examples with the market bucking the average, and also there's not a lot of cases either. So these are tendencies. They need other catalysts. And I think what we have been focused on over the past several weeks is this earnings situation where earnings estimates the second half of the year haven't come down, whereas in the first half of the year, when we're going to Q1 and Q2 earnings seasons, the numbers have already been brought down quite a bit. So analysts are expecting double-digit earnings growth the second half of the year. And while we're not in the recession camp, we're not in the no landing camp either. So those estimates probably need to come down. That's probably a bigger part of it. But you throw on the election anxiety, and it adds to a reason to maybe not put money in the market, at least for the short term.
Right. And in the short term, I'm looking at how the market has done so far since the start of the month, and energy stocks leading the gains up about 4.9%. Is this backed up fundamentally by earnings numbers? I mean, in terms of earnings estimates and what people expect for this sector?
I think a lot of it really is sentiment driven, but we do think in general, if we want to broaden the discussion more to the cyclical side of the market, we have been looking for a chance to rotate from defensive into cyclicals going into the election. We call them the shut sectors. That's staples, healthcare, utilities, and telecom tend to outperform. That's actually happened even though the market has continued to rally. The defensive sectors have done well, particularly utilities. And now as we move forward past the election, we would think there'd be a more of a cyclical tilt to the market, especially as it becomes clear the recession isn't going to take place. So that's probably the bigger picture. And again, you throw on a little bit of geopolitical risk, and that certainly gives energy stocks a lift.
Right. Now, speaking of rotation, our previous guest, Frank Monkam, was just telling us how there might be a little bit of a rotation out of U.S. stocks, given that they still are holding near record highs, into something that is under-owned at the moment, like Chinese stocks. Do you see any signs of this happening? Is there any evidence of that?
Well, I think the sentiment towards Chinese stocks was so negative because the message from the U.S. perspective is, China's a dead zone for global investment, and there's this blocking off of the economies between U.S. and China. But I was in Europe last week visiting clients, and it was remarkable how different the sentiment is over there, and the recognition that China is a huge economy and they're going to have to figure things out even if the U.S. is more protectionist, and they're leaders in several sectors. And so maybe sentiment got a little bit overdone, and then you throw on pretty much the Chinese government just trying to throw a lot of stimulus at the problem, and maybe that will lead to a tactical rally. Now, long term, we're not so excited about China. We do think that the U.S. is a better place to be for demographic reasons, for openness, governance, and also long-term earnings growth. But that doesn't mean China can't have a nice rally.
Yeah, certainly not, particularly when you consider how close to some of their lows, or I should say how far off their highs they are. And that seems to be the bet, Ed, that it's not so much that the U.S. isn't a better investment landscape. It's that when you're looking at those long-term returns, at least coming from the base effect over there, that there is a lot more upside, presuming some of those issues that you just raised don't actually come to fruition.
Yeah, so it's a sentiment story, and then let's expand the discussion to Europe, where there might be actually a mild recession. So I think there's some concerns over there. So if you're a global investor, you're trying to figure out where to go. You may like the U.S. You may want to have a little bit of diversification. Maybe looking at the sentiment situation in China, maybe an opportunity for a little bit of rotation until maybe some of the other parts of the world find their footing.
All right, Ed, going to have to leave it there. Always great conversation. Ned Clissold is the chief U.S. strategist over at Ned Davis Research, counting us down to the closing bells here on this Thursday afternoon. Scarlett, down about 0.2% on the S&P. Kind of interesting to see transports, your big laggard, at least among kind of the major indices, down about 1.5%. Yeah, especially given the port strike, you would have thought that some of those names might have done a little bit better. I'm thinking about FedEx and UPS and the likes. I was just checking to see if the S&P 500 is near any kind of technical level that's interesting. No. Yeah, what'd you find? Nothing. Yeah, not it's even, well above the 50, the 100, and 200-day moving average. Not the reverse. I'm kind of at a loss. The Jimmy Fly Snookum. We're just looking for some kind of direction. Nelson. No. Okay.
No, doesn't check the box.
All right. We are moving closer to the closing bells. We're going to have a full breakdown of those technical and fundamental levels right now as we come back. This is Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you to the closing bell, a global simulcast. It starts right now. Carol Massar and Tim Stenovic helming the radio booth. Alex Seal on assignment. As we welcome our audiences across our Bloomberg platforms, including our partnership with YouTube. A third day of softness in equity markets and a third day of strength in oil markets. Carol Massar.
Yeah, that's where I was going to go. No softness when it comes to those energy names. It's the best performing major industry group in the S&P 500. So I'm looking at energy as a whole, up about 1.5% here. And of course, it has to do with those Middle Eastern tensions and specifically concern about do the oil markets, how might they be impacted in the future because of it?
I'm already thinking about tomorrow, 8:30 a.m., change in non-farm payrolls for the month of September, 150,000. Jobs added is what the survey of economists by Bloomberg is anticipating, but we got quite the range when it comes to how investors are thinking about it, Scarlett. 70,000 up to 220,000. So
sounds like nobody knows. Nobody knows anything.
Again, nobody knows.
And you wonder whether that's actually going to be the catalyst that jolts things and changes things up, right? I'm looking at volume, and it's about 18% below the 20-day average. It feels like a really meh day overall. No technical levels that are of any kind of significance. The RSI, we're not anywhere near anything that suggests that we're at an inflection point. So just searching for a catalyst.
Yeah, searching for a catalyst. And of course, that may potentially come at 8:30 a.m. tomorrow when we get that monthly jobs numbers, or maybe not. It's a big sort of question mark right now, as everyone really is trying to game the direction of the Fed, and at least for right now, the direction of what's going on in the Middle East and the response to it. Let's walk you through the numbers here in the U.S. as we get the closing bells in New York. Right across the screen, a little bit of a shift from what we saw yesterday, with the Dow Jones Industrial Average down by roughly 185 points, or 0.4%. The S&P 500 looks like it's going to settle just below 5,700. That's down about 10 points, or 0.2%. We're going to call the NASDAQ Composite unchanged on the day, right around 17,918. Similar story for the NASDAQ 100. But you did see more meaningful moves lower in that cyclical and small cap space. The Russell 2000 down 0.7% on the day, and Dow Transports down 1.4%, as all but three of those members finished the day in the red.
All right, so some pressure certainly from those groups. Looking at the S&P 500 overall, guys, most names lower today, almost 400, 387, losing some ground today. Scarlett, you had 114 to the upside, and you had 2 unchanged.
All right, looking at the sectors, you've got 11 sectors in the S&P 500, only 3 in the green. Energy, the best performers, Carol, as you mentioned, not just for today, up 1.5%, but for the month as well, up almost 5%. Technology doing well, with NVIDIA helping lift some of the chip makers, and communication services just squeaking into the green. Consumer discretionary, materials, and REITs losing ground today.
All right, guys, let's get to some of the individual gainers. An easy one for me, NVIDIA, up about 3.33%.
Took the easy way out, I see.
Occasionally you have to do that. Top gainer in the NASDAQ 100. You guys know the story. Positive comments out of Jensen Huang, the CEO of the company. He talked about the Blackwell chips. This was on CNBC. He said Blackwell is in full production and demand for Blackwell is insane. I know we've all...
Insane.
That's what he said.
Insane in the membrane.
Those were his words.
Okay.
Words that could come back to haunt you,
How do you
know?
quantify insane?
Oh, it will come back to haunt him. I guarantee you
Right?
somebody's already clipped that and is just waiting for that one day.
Right, exactly. Like, remember when you said the comments come, though, amid some concern specifically about the engineering snags that the company has had because of a delay that we received in that Blackwell chip. All right, let's get to Constellation Energy. We've been talking about this one now for a couple of weeks. It was a top gainer in the S&P 500 and the NASDAQ 100, up about 4.5% in today's session. Been on fire since news of reopening that one Pennsylvania facility to power Microsoft data centers. Well, RBC Capital raising its price target to $272 from $214. The stock's above that already, closing above $277 a share. RBC keeping its sector perform rating on the shares. So, yeah, that's coming out. I should also point out.
I should point out, too. I hope Tim does Constellation Brands. That's
come on. I almost queued him up for that.
I gave it. Oh, sorry.
Yeah. Oh, okay.
Spoiler alert.
I just want to say, Wall Street Journal is also out that the owner of the shuttered 3 Mile Constellation is pursuing a $1.6 billion federal loan guarantee to help finance its plan to restart that Pennsylvania facility. So a bit of news. EVgo, I don't know if you saw this one.
Yeah, we did.
Huge move.
Up more than 60% in today's session.
I'm all for this.
What?
I'm all for this.
Why?
I mean, you need charging infrastructure, right? I mean, that's been a big impediment to, I think, EV adoption. It just can't, all just be these Tesla chargers. And, if you're going to have a broad array of companies, I don't know if this company's capable of fulfilling that, but great story. Sorry to interrupt.
No, that's okay. But they got a conditional loan guarantee of up to $1 billion from the Department of Energy to expand its network. So maybe they're listening to you, Romaine. JP Morgan also upgraded the firm.
They're big fans of the show.
Saying that it expects it will outperform some of its peers. All right, so Tim, we queued you up.
You did, but I'm starting with Tesla because the shares are down for a third day in a row. Down more than 8% over the last 3 days, falling today by 3.4%. Lots of Tesla news today. The company notified U.S. auto officials of a 5th recall involving the Cybertruck in less than a year since this pickup has been out. Tesla employees also were told that the chief information officer is leaving the company just days before it's set to unveil robotaxi prototypes. Company pre-marketing $783 million debt sale backed by prime borrowers' car leases. And then Reuters reported after the bell yesterday that Tesla has discontinued at least the least expensive version of the Model 3 in the U.S. Tesla shares falling again today, third day in a row, down by 3.4%. Here it is. STZ is the ticker. You had Constellation Energy, Carol. I'm going with Constellation Brands.
Finally.
We're not drinking enough beer. Lower because it turns out that we got to drink more beer. Shares of Constellation Brands, it's the parent company of Corona and Modelo, reported weaker than expected beer depletions for the fiscal second quarter. Analysts did note.
What does that mean?
Less beer is depleted than they wanted it to be. It's just another fancy way of saying how much beer we're drinking.
Beer depletions.
Yeah.
That's an industry term.
Analysts said that scanner data have signaled improving trends in recent weeks, though, so go drink that beer, Scarlett.
Gladly.
Levi's finished the day down by 7.7%. It was down nearly 12% earlier in the session. Challenges abroad, declines across its home market, and Dockers brand drove to a cut to its full-year guidance. The company does see weaker sales growth for the current fiscal year. Dockers options could be a sale. They've hired Bank of America as a financial advisor. Dockers brands declined 15% in the last period.
Romaine, there's some Dockers on sale right now.
I mean,
maybe Mary Rose Gilbert said maybe they'd sell to a company like Authentic Brands Group, which pretty much owns everything out there.
I know, but I mean, it seems like such a bland brand. I mean, I don't know, anybody can make khakis. So maybe that's why they're doing, I don't know, maybe, can they get Beyonce to wear some Dockers? Maybe that would help things. Let's take a look at what's going on in the yield space. The second straight day where we've seen yields move higher, particularly on the shorter end of the curve. And of course, a lot of that has to do with what's been going on with the dollar and what's been going on overseas. About 7 basis points higher on your 2 and your 10-year yield, 6 basis points higher on the 20 and 30-year yield. Carol, they told me that we were going to chat about something really, really serious here. I'm sure it's either about markets, about the economy, about the election, what?
From the man who brought us the bears fighting, you're going to tell me about serious. Okay.
I'm still bitter that you did not like the fat bear chat.
The bear chat. No,
Can we do that right now?
This is payback right now for that.
Well, Tim was talking about beer depletions. How about skin depletions? There's this incredible story that just popped up from the Wall Street Journal. It has to do with Cheetos and a particular yellow dye, number 5. And apparently, it's a popular food dye in Cheetos. I mean, you know that color so well.
It's made with real cheese.
And apparently,
I never knew that.
This food dye can turn the skin of live mice transparent and show the organs inside.
What?
And scientists have done this experiment.
Yeah, so they just eat this stuff and they turn transparent?
No.
No?
You actually put a solution on the bellies of live mice. Have you ever done science experiments?
I've never rubbed Cheeto dust on the belly of a live mouse. I can assure you of that.
Hopefully you've never rubbed anything on the belly of a live mouse.
Come on.
It revealed the inner organs and pulsed muscles in the gut. After soaking the mice's heads in the solution, according to the Wall Street Journal, they saw blood vessels that sluice the brain. Applied to hind limbs, the dye showed muscles in the legs.
Okay, I
don't know. Sounds like superhero powder to me.
Wait, all right. Science research can be crazy, but think about if you didn't have to have X-rays or things that you could in the future maybe put this on,
Cheetos dust,
rub this on the romaine belly, and then you could see the organs inside.
My belly. I don't like that.
Well, we can just experiment, right? You get a bag of Cheetos and you just rub the dust on your fingertips.
I try to get Tim to kind of help me out.
Maybe they'll be see-through.
All right, Scarlett, what do you got?
All right, here's another story that we're watching. You know how a lot of public schools around the country are banning cell phones because it's been such a distraction to learning. That was proposed in New York City. They were going to move forward with it, but there was an incident in one of the public schools last week in which they went into lockdown because there was talk or there was reports of some kind of active shooter. That didn't turn out to be the case, but parents couldn't reach their kids, so parents are pushing back and saying, no, do not ban cell phones. This is something that gets everyone up in arms because teachers can't teach when everyone's distracted and checking Instagram.
Tim's really heated about this.
I am. As a parent of young children, you try to keep them away from technology.
Yep.
I think it's a good thing to have technology like this out of the classroom. So much research has shown that the students concentrate so much better without these things.
Yeah.
I don't know, Romain, what do you think? Did you get your new iPhone, Romain?
I did. I spent all last night setting it up for him. But the great thing about it is I know exactly where he's at all the time. So thank you, technology. It's not like the old days, Tim. I used to leave the house for hours. My mother had no idea where I was.
I know, right?
Somehow I survived.
You left in the morning and you came back for dinner.
I know.
And we all survived, and here we are.
Well, sort of.
All right, I'm going back to Cheetos. Damaged. All right, yeah, it's debatable. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Guys, we will see you for the Friday edition tomorrow.
A lot more coverage coming up here on Bloomberg Television. A closer look at the latest day of the port strike with more than 36 container ships piling up outside some of those ports, anchored outside of those biggest ports in America as the dock worker strike threatens to intensify the bottleneck. A discussion up ahead right here on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
An interesting day on Wall Street here when we talk about a market that is looking for direction, a market that thought it had found it just maybe about a couple of weeks ago on the back of that Fed meeting, and a market now a bit listless. You're seeing softness for a third straight day here in the S&P 500, down about 0.2%. You saw similar moves for some of the other major indices here, but a lot of the activity you're actually going to find in the commodity space, in the FX space, and in the Treasury space. Treasury yields higher on the short end by about 7 basis points on the day. You saw further dollar strength, particularly against the pound. In fact, the pound at one point was having its worst day in at least 2 years. Some interesting comments by Governor Andrew Bailey about maybe an acceleration in their rate easing cycle over there in the UK. And take a look at NYMEX crude, almost $74 a share, Scarlett. This is a big turnaround from where we were even just about a week and a half ago. And of course, we were speaking with Frank Monkam and a few others earlier today. Big questions here about whether these gains hold.
Absolutely. But for now, it's giving a lift to energy stocks, not just for the day, but for the month so far. In terms of today's big movers, let's take a look at NVIDIA, the best performer among the Mag 7 names, on positive comments from CEO and co-founder Jensen Huang on its next-gen Blackwell chips. He told CNBC that demand for Blackwell is insane. No quantification of what that insanity might look like, but that was enough to lift the stock. EVgo gaining 61% on the day. This is an EV charging company, and the Department of Energy gave it a $1.1 billion loan commitment to expand its network. So as a result of this LA-based company can build out about 7,500 additional fast charging stalls across the country, across metro areas in the U.S. And Constellation Brands down almost 5% on the day. This is a beer maker. It reported weaker than expected beer depletions. That's the number of cases sold to retailers and then sold to consumers last quarter. Moving along here, our top story this hour is the linkage between municipal bonds and demand for labor. In the past 3 to 4 years, school districts across the U.S. used $190 billion in federal aid to hire thousands of teachers and administrators. But that pandemic aid is now expiring and forcing districts to cut staff and services, overhaul their budgets, and renegotiate teacher contracts. And in some instances, it might mean borrowing money by selling tax-free bonds. We're going to be exploring the larger dynamics between the labor market and munis later this hour.
All right, we do want to get you an update here on what's been going on with that port strike. The dock worker strike has drowned up ports along the East and Gulf Coast, and right now you have at least 36 vessels anchored outside those areas. It's already creating a bottleneck that is only expected to get worse. Lisa DeNight joining us right now over at Newmark, National Industrial Research Managing Director over there. And Lisa, let's first start off here with the backup that we're seeing in ships right now, because of course everyone is looking back to what we saw in 2020 and 2021, particularly out there on the West Coast, where you had just ships just idling for days, weeks even. Are we at any real risk of seeing a repeat of that level of bottleneck?
You know, this is the most, I'd say, impactful supply chain disruption that we have seen since COVID. So that is a real concern. I think there's about 60 more ships that are coming this way soon, so that the pileups could get near COVID levels really quickly if this is not resolved shortly.
Is there any sense here, particularly with those ships that are on the way here, is there any viable chance that they would find a way to reroute away from those Eastern Gulf Coast ports? I know that's a long way around and probably an expensive way around, but what other options are there?
Well, there are other options, certainly in Mexican ports, Canadian ports, West Coast ports, well, certainly leading up to this strike, there were a lot of ships that were preemptively diverting to West Coast ports. The Port of Long Beach, for example, saw its best ever month of all time in August. So there was a lot of preemptive diversion. We will probably see diversion happen if this strike continues. And yes, West Coast ports are expected to be some relief for these ships, but Mexican ports, Canadian ports are also, different alternates. And then, of course, there's air freight. That is another lever of optionality to be pulled, a much more expensive lever and one that doesn't work for all goods. But that is another option that is being considered as well.
So talk a little bit about these contingency plans that companies have undertaken in order to mitigate some of the disruption. We know that they've, like you said, moved things over to West Coast ports, for instance, but they're also, having ordered a lot of things in advance, they need to store it in a lot of places, and that's resulted in business opportunities in other parts of the economy.
Indeed, yes. There was, retailers saw this coming. Certainly months ago, there was a lot of questions about whether or not a strike would happen, but a lot of retailers did want to front load their inventories to avoid any potential disruption. Resiliency in supply chains is key. There's been years of disruption at this point, and if you can solve for potential disruption, you're probably going to choose that option. So there were a lot of goods, especially when you think about Christmas time goods, holiday season goods. There were a lot of goods that were brought in ahead of time, leading to very strong import levels during the summer in particular. So there are, I'd say, comfortable business inventory buffers, which have been filling warehouses and supporting industrial occupancy. So that is a positive sign here, but you can only front load so much. So there really does come a point where this strike duration starts to impact what we see on the shelves.
How much capacity is there in that warehouse solution, whether it's short-term solutions or whether it's something like outdoor storage space as well?
Yeah, so this is another good counterpoint to talking about COVID-era disruptions, because during the height of COVID-era disruptions, 2022, let's say, where we saw the biggest backups, that was also the point in time for the industrial market where warehousing vacancy was at an all-time record low. So that just compounded issues for mitigation strategies around that point in time. Where we stand now in the industrial market, we actually have capacity. That's a big difference between then and now. There's been a generational injection of new supply in the U.S. industrial market. There's been a lot of new construction that's hit over the past 2 years. So the U.S. industrial vacancy rate is a little bit higher than that all-time low that we saw during the pandemic. It's around 6.4% right now. Yeah. So there are definitely, especially if this has a duration, there's definitely going to be a need for short-term warehousing solutions. You mentioned outdoor storage. Industrial outdoor storage is going to be I'd say the demand will be exacerbated for that. There's already strong demand. So there is capacity in the industrial market now to absorb some of those goods that need somewhere to go.
When we came out of, I guess, some of the supply chain issues that were a result of the COVID pandemic, you saw a lot of investment in certain areas of the supply chain. Some of the issues that you were just talking about with warehousing, some of the issues at the ports themselves, obviously on the rails and trucking front as well. Do you think we're going to see more structural type investments? And with the hypothetical that this particular strike does drag on, are we going to start to see more of those types of structural investments in making that supply chain more resilient?
I think that is absolutely what we're seeing now in terms of a long-term macro structural shift. We are seeing a lot more investments in resiliency from global corporations that have consumers that they sell to in the United States. There's been a wholesale re-examination of these labyrinthine supply chains that has driven a lot of investment in manufacturing, both domestically and in our partner countries in North America, especially Mexico. There's been a lot of nearshoring demand in the industrial market in Mexico. We're already seeing the impact in freight flows coming across the border from Mexico to the U.S. So yes, that will absolutely continue as corporations want to de-risk the supply chain.
Lisa DeNight is National Industrial Research and Managing Director at Newmark. Thank you so much for joining us on this story, this developing story. Something else that caught my interest is, Americans, I like Costco because I know you don't go to Costco and you haven't stepped foot in there.
No,
but Americans really like to go to Costco and stock up when they think there's going to be a shortage. And apparently, an Oppenheimer analyst has gone to Costco and noticed that they have run out of things like toilet paper. They've run out of paper towels. They've run out of water because of concerns related to the port strike. Costco shoppers are very sensitive to disruption to their supply chain.
And by sensitive, you mean they don't quite understand like where the stuff is made. So I saw these pictures on the internet, and my first thought, I literally thought this was all related to Hurricane Helene and some of the natural disasters.
Which would make sense.
Because we went through this. I know everything about toilet paper now because of the COVID crisis. And I know that 90% of our toilet paper is made right here in the good old US of A, as it should be. Most of our water comes from the good old US or from North America. Not everyone's
checking the provenance of that.
And so my question is, how does a port strike affect your ability to do your business in the bathroom?
You just never know. Maybe their trucks will get, stopped somewhere else, can't get through, and you want to be able to have everything. If you have room in your house, and most Americans have a lot of room in their houses because, they live in big houses.
Okay.
Or at least Costco shoppers live in big houses, let's put it that way. Then you can afford to stock up and, put your mind to rest.
And then what happens when the strike ends and you're sitting there with a year's supply of toilet paper? You're probably still working down your COVID inventory.
No. Just from last year, that's all. Coming up, the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Joe Tsai. The owner of the Brooklyn Nets and New York Liberty basketball teams is in talks to buy a stake of the Miami Dolphins from fellow billionaire Stephen Ross. And it's not just the Dolphins, I should mention, it's also Hard Rock Stadium and F1's Miami Grand Prix. But the deal could value the Dolphins at $8.1 billion.
Yeah, some of the valuations of these teams have really astonished me. And I know this is still, basically the biggest sport in America, and it continues to grow. But at some point, it's just like, my gosh. What I love is like when you see like the old time NFL owners, when they're selling out as they started to age out.
Yeah.
And then they're like, yeah, I bought this for like $300 grand
I know,
back
and
in
look
1965. And it's like, all right.
They're laughing all the way to the bank.
All right, I'm keeping an eye on Tadashi Yanni. You may not know his name, but you certainly know his companies. The CEO of Fast Retailing, which owns the Uniqlo brands, has now donated $31 million to the University of California, Los Angeles. And what I really love about this story, this is a record gift, by the way. And what I love about this story is he broke his own record. He had previously held the record for the biggest gift after he had donated something like 20-something million here. This for to kind of help a Japan studies and cultural studies enrichment program there. But I just find it funny that he basically broke his own record because I guess when you're a GOAT, that's what you do.
You know what? Next year he'll probably break the record again.
Yeah, why
right?
not? Sure.
Yeah.
No one will catch him.
Speaking of GOATs and the fact that no one can catch someone, let's talk about Michael Jordan. The NBA GOAT, who also owns a NASCAR team, has joined a lawsuit accusing NASCAR of antitrust violations. Now, unlike the NBA or the NFL, NASCAR is not owned and operated by its individual teams. Instead, it's controlled by the France family. And Michael Jordan calls NASCAR and the France family monopolistic bullies.
Yeah, well, good for him. I mean, this is basically how it's been run. And, you know, I guess somebody of his clout who can actually say that out loud and stand up to him, maybe he can make some changes here. But, you know, I mean, to the point, you know, that I think Jordan also is also making, or at least the law, you know, at least the what is the lawsuits are making is this idea of being able to have sort of ancillary things that are outside the NASCAR thing and not being able to do that. It's just, it basically says limits what the team can do. It limits their revenue here. So he has a good point. I don't know if it's a good legal point, but certainly in the court of public opinion, I'm all for it.
And maybe that's all it needs, right? NASCAR teams are independent contractors, unlike NFL teams. They're allowed to compete based on these charters that last 4 years but need to be renewed. So it's not a permanent charter. They have to apply for it each time.
Yeah, I'm all in for this fight because, you know, Jordan could be a little. Be careful. You know, you don't want to make him mad.
Have you seen the SNL skit on Michael Jordan?
I don't know. I've seen every skit on Jordan, so all I know is don't mess with that guy. All right, when we come back here after the break, we're going to take a look back in history and a look back at the global financial crisis and the Wall Street bailout that almost never happened. That's coming up next.
Almost.
This is The Close on Bloomberg. All right, let's take a look back in history to October 3rd, 2008. That was the day President George W. Bush signed the Emergency Economic Stabilization Act, a sweeping piece of legislation designed to inject capital into a reeling U.S. financial system. Now, the legislation's centerpiece was the $700 billion Troubled Asset Relief Program, TARP. They used taxpayer money to hoover up billions of toxic debt held by banks, a clean sweep, a clean wipe of balance sheets that, in theory, would keep the banks solvent and encourage them to continue lending to consumers and businesses. It would be the biggest government intervention in markets since the Great Depression, and in hindsight, it would prove to be one of its biggest successes. Not only did it keep many financial companies solvent, but by 2014, the program actually turned a profit on the money spent. But it almost didn't happen. Yeah, there were dire warnings from economists and investors that without government action, the financial system was set to collapse. But Washington, well, that's a fickle and nonsensical beast when it wants to be. In a stunning vote of 205 to 228, just about 2 hours before markets were set to close on that drizzly Monday afternoon, the House of Representatives rejected that bailout program. Markets didn't take it well. The Dow average had its biggest point drop ever. The S&P 500 had its biggest percent drop since October 1987. The VIX spiked to 47. Two-year Treasury yields plunged more than 40 basis points, and oil dropped 10%. In money markets, overnight index swap rates, one of the best measures of credit risk, they rose to all-time highs. In fact, some say that the scariest day of the 2008 credit crisis, it wasn't the day that Bear Stearns collapsed on March 16th. It wasn't the day Lehman failed on September 15th, or even the day Washington Mutual failed on September 26th. It was September 29th when the House failed to do its duty and voted down that bailout package that President Bush himself had said was necessary to avoid a long and painful recession. Now, while Congress wasn't willing to listen to their president, they did take the message from financial markets, and they took it loud and clear. A slightly revised bill did finally pass the House on October 3rd, just before 1:30 p.m. while markets were still open, and it was rushed down Pennsylvania Avenue to the White House, where Bush signed the legislation less than 2 hours later. Scarlett?
Look how young those lawmakers look in those old videos. That's what I can't get over. And of course, in the end, they did do what they needed to do, but it took a while to get to that point. All right, let's look ahead now to tomorrow because we get our latest read on the labor market with the release of the September jobs report. This coming in after this morning's weekly jobs claims, which showed an uptick in applications for unemployment benefits. Tomorrow's data, a key indicator for the Fed as the central bank looks to continue cutting rates in its fight against inflation that has now morphed into supporting the economy. Joining us for more on this is Louise Sheiner, a Robert S. Kerr Senior Fellow in Economic Studies at the Brookings Institution. Louise, when it comes to the big jobs report, when inflation was public enemy number one, we fixated on average hourly earnings as the data point to key off of. Now that the labor market is the primary concern for policymakers, is the focal point going to be non-farm payrolls and the number of jobs added, or is it going to be something else?
So thank you for having me. It's good to be back. So I actually think the most important number that's going to come out tomorrow that the Fed will pay the most attention to is the unemployment rate. The unemployment rate, which as you showed was 4.2 last month, is expected to stay the same. It has been rising as the labor market has been cooling. And the real worry is whether or not it's going to sort of start stabilizing or whether it's going to keep ticking up. And therefore, the Fed would say, oh, wow, we really have to focus on the employer side of the mandate. And the reason that they're going to look at the unemployment rate more than the number of jobs is that it's actually become very difficult to interpret those job numbers in the sense of, let's say it comes in at 150. Is that a very strong labor market? A kind of strong labor market? How do we know? And the reason it's really hard is that there have been very big changes on the supply side. How many people are looking for jobs? What's happening to the labor force? That's because there's a cyclical response of labor force participation. Participation has been rising, and because of immigration. Immigration increases the size of the labor force. It increases the size of jobs. We don't have great data on immigration. We're not sure exactly what's happening. It takes time for people who come here to get into the labor market. It just puts a whole bunch of uncertainty around those job numbers. The unemployment rate doesn't have those problems. And so that's really what they're going to be focusing on most.
Okay, got it. And we should mention that the non-farm payrolls number, the range is pretty wide for the estimates out there. Anything from 70,000 to 220,000, to your point on how there's not a whole lot of clarity on what the number might look like. You mentioned the unemployment rate, that's U3. For a while, I remember we were all fixated on U6, which is the underemployment rate, which considers the percentage of people in the workforce who are working part-time but want to work full-time. Is that kind of metric useful in this kind of economy when things are slowing but not when we're anywhere near a recession? Or is that something you look towards when you're recovering from a recession?
I mean, I think in times like this, most of those unemployment rates kind of move together. And so we could end up looking at just the headline unemployment rate, and that's basically sort of a sufficient statistic for what you're looking for. There are times where people have become so discouraged, they leave the labor force, so you want to look at broader elements, but we are not there yet, as you mentioned. We are still just sort of at the beginning. I mean, what we do look at is the JOLTS that came out this week too, which is another measure. And we look at hiring rates and quit rates and layoff rates. And it's consistent with this kind of being the beginning of potential problems is layoff rates are still quite low. But things like quit rates and hiring rates, they're still pretty good. We still have a solid labor market, but it's not as good as it was in 2019. So it's looking weaker. So employers aren't hiring as much and people aren't quitting their jobs because of that, because it is harder to find a job now if you've lost a job, even though you're not likely to get fired.
Are there any regional trends, though, out there? I know we sort of look at these numbers in aggregate, but we've talked with a lot of economists who've actually raised some concerns that there are a lot of layers right now to this job market when we talk about whether it's healthy or whether it's not. Any way for you, Louise, to pick apart those layers and point out where maybe that stratification exists?
I mean, there's always differences across the country. Some places will be doing better, some places will be doing worse, partially dependent on sort of what industries are being hit at some point. But, you know, Powell was asked about this at the NABE conference this week. He was there, and they asked him about that, and he basically said, look, we look at the headline rate because we're doing monetary policy. And so we sort of are affecting the whole country. And so we're not going to respond to like a high rate in a particular state. So I think, you know, there's always variation, but I think focusing on that headline rate, especially from the Fed's perspective, is the right thing to do.
When you look at where monetary policy is right now, and you had a seat at one point as an economist over at the Board of Governors, you also had a seat on the Council of Economic Advisors. So let's just bring fiscal policy into it as well here. Where it stands right now, is that supportive of additional job gains and a further tamp down in the unemployment rate?
So I don't think so. And that's why the Fed is on this easing cycle, right? I mean, as inflation has come down, real interest rates have risen, and they're actually quite high given the fact that we are now seeing a labor market that is, you know, weakening and not too tight, right? It's not like it's weakening from a very tight place. It's now like a pretty solid labor market, but it's not at all too tight. And so any weakening is going the wrong direction. So the Fed is clearly going to cut rates. They've told us they're going to cut rates. And the real question is how fast? Right. And this is kind of this balance, which is they don't want to go too fast. They want to give themselves time to see the data. They don't want to look like they're panicking. On the other hand, if they're behind the curve, they're going to say, well, the data came in and it's weaker than we thought, so we're going to cut quickly. So they cut 50 on their first cut. And so the big question now is they're going to cut next meeting, but is it going to be 25 basis points or 50? And this labor market report, and they get one more before their meeting, those two, I think, are the critical inputs, so long as inflation remains contained as we expect it to be.
We only have about 30 seconds, Louise, but I am curious about that next report in October. There's already a lot of people dismissing it, saying that historically has a lot of distortions in it. Do you buy that?
I mean, I think people are worried about hurricane effects, and so that just gives some uncertainty. But I mean, I think the Fed is going to look at it, and they're going to look at all the data, but they're also very careful to look at special stories and not get, they'll look at which states were affected by the hurricane and discount some of those states if we see big claims. So they will look at that report.
All right, Louise, always a great conversation, and appreciate you taking time for us. Louise Sheiner over at the Brookings Institute, also chair of the Bureau of Economic Analysis Advisory Committee, and a former staff economist at both the Fed, the Treasury, as well as the Council of Economic Advisors. One thing that she just did mention in that conversation was the JOLTS data that we got earlier this week. The number of available positions actually rising to just above 8 million. Now, one trend, though, that stuck out was the number of openings in state and local government positions. And with the pandemic aid that funneled a lot of money into those governments set to expire, there's some questions here about how those jobs numbers and job openings could change. It's part of today's Muni Moment, and pleased to bring into this conversation for that is Cooper Howard. He's Schwab Center's for Financial Research Director of Fixed Income Strategy. Cooper, great to see you back on the program. I do want to start off with the hiring that we've seen in state and local governments. We know it was depressed for a while because of the pandemic. We've returned to pre-pandemic levels, at least in aggregate here. But of course, this is still dependent on economic conditions and, more importantly, the health of the balance sheets of these municipalities.
Yeah, you're correct. We have seen some gains in the state and local government sector, and they've come back to a more normal level to where they were slower to respond relative to the rest of the economy. So if we look at kind of the overall health of the balance sheet for state and local governments, we don't have too many concerns with credit quality for most municipalities. In fact, over the past 15 quarters, there have actually been more credit rating upgrades relative to downgrades. So currently, the state of the muni market, if you look at the average municipality, the average issuer, about 7 out of 10 of those are either AAA rated or AA rated. So the backdrop right now for credit quality for municipalities appears relatively favorable. So we don't have too many major concerns right now, Romaine.
Do you feel that those municipalities have the discipline to hold that line? Because we've already seen a couple of them sort of squander the gains that they made coming out of the pandemic.
Yeah, so you're obviously going to get divergences. The muni market's $4.4 trillion large in terms of the size of the issuers outstanding. So there's a large market. You're going to get divergences. So there are going to be pockets of risks. But overall, we don't necessarily think that there are major risks that we're seeing. So a lot of the pandemic aid, like you said, it did go a long way to kind of cover up a lot of warts. But also what we saw is that we saw a surge in tax revenues, and many state and local governments actually used those revenues to build up their rainy day funds. So a rainy day fund is akin to like a savings account for you and I. So some states have had to start to tap into that to help smooth revenues. But given the size of those rainy day funds, that can go a long way to smoothing any sort of credit concerns.
School districts that got pandemic aid did not use that money for rainy day funds. They spent it immediately on teachers, on administrators, on services for students. And that aid is going to end soon. And those school districts will have to make some hard decisions on whether they cut those services or whether perhaps they need to borrow money to keep some of that going. Do you anticipate a wave of issuances from school districts in the coming months and years?
Yeah, that's a very good question, because year to date, we've actually seen a very big surge in issuance. Going into the election, my expectation is that we'll probably see a decline in issuance. Also, it's very important to look at what is backing a specific municipality. So for many local governments, which are school districts, those are backed by property taxes. Property values have been increasing on a year-to-date value. If you look at the Case-Shiller index, it's up about 4%. So again, that backdrop looks relatively favorable, but I wouldn't be too surprised on the issuance side of things if we do see a little bit of an increase in issuance next year. But shorter term, it's probably likely to slow a little bit.
Okay, talk a little bit about what continued rate cuts from the Federal Reserve later this year, at least 25 basis points in November, December, would mean for issuance in 2025.
Yeah, so we would expect that that would go through and see lower borrowing costs and therefore probably a little bit of an increase in issuance. I think also what's important with the Fed rate cuts is that we know that rate cuts are coming. So we can debate between if is it going to be 25 basis points, 50 basis points, how's the non-farm payroll going to influence that tomorrow? But overall, our expectation is that we're going to get 225 basis point rate cuts and then continued rate cuts into next year. So our house view is 4 rate cuts of 25 basis points, so a total of 100 basis points next year. I would expect if we do see lower borrowing costs, then that should also be a sign of increased issuance.
And then this gets back to the other issue, though, too. And I have to ask you about with the big election coming. And I know the focus has all been, of course, on the presidential race, but we kind of forget, you still got a House race with hundreds of seats up for grabs here, and not to mention, governor's races, et cetera, here. Any chance that that could reshape your outlook for munis into 2025?
I think when you look at politics and kind of the outcome of the election through the eyes of the municipal bond market, how I'm looking at it is, are there going to be changes to tax policy? So we know that municipal bonds issue a tax exempt interest or pay interest that's generally tax exempt. So if there is a change in that tax policy, that's where I think that could influence things. Now, we're also suggesting that it's way too early to make changes in your portfolio based off of what's been discussed on the campaign trail. So I think looking forward, though, the 2017 Tax Cuts and Jobs Act are set to expire. So how does that change? What does that look like going forward? And that's really going to be influenced by the makeup of Congress as well as the makeup of the president. So I think that there's a lot of dominoes that could fall between now and what actually happens with the tax laws and tax policies, that it's just way too early to really shift things in your portfolio.
Yeah, we might not get the answer until well into January as well. Cooper Howard, Schwab Center for Financial Research, Director of Fixed Income Strategy. Thank you very much. When it comes to how markets closed on the day, there's not a whole lot to talk about here because modest declines here in the S&P 500 and most of the major indexes, with the exception of the Russell, which closed down 0.7%. Really, investors in search of a catalyst, they're definitely on edge as we await more developments out of the Middle East. You could see crude and the dollar moving higher. The pound was the big loser on the day in currencies because of what the Bank of England governor has said about maybe the need for more rate cuts. This is The Close on Bloomberg. Landlords for offices, apartment complexes, and other commercial real estate have $1.5 trillion of debt due by the end of 2025, according to some estimates. Many will have to refinance at higher rates. Strategic Value Partners founder Victor Kosla says this means a wave of bad news is coming.
When we look at a whole bunch of U.S. office real estate, there are problems galore. You don't see it in the headlines quite as much, but underneath those debt maturities, there's almost a tsunami coming through.
Joining us now for more on this is Natalie Wong, who covers U.S. commercial real estate for Bloomberg News. And Natalie, Victor Kosla's SVP says it's looked at 100 deals in the office sector over the past 6 to 9 months and made just one deal out of 100 that it's looked at. Is that emblematic of the lack of activity in that part of the commercial real estate market?
It really is. A lot of people still do not want to touch offices, especially the more distressed, older quality type offices, of which there's a lot in major cities across the U.S., right? Office values have seen their values drop the most out of all commercial property types, down 37% from their peak in 2022. And a lot of people still think that there's going to be even more drop to come in the near future because these buildings are just not filling up. It's been 4 years since the pandemic. It's clear that even though companies are bringing workers back to the office, they just don't want to lease space in many of these older buildings that their employees don't want to be in anymore.
Well, that's what I'm curious about. When we're talking about these types of buildings here, are we talking about buildings that basically have no other use, or at least no discernible use other than office buildings? It's kind of funny. I mean, we're actually showing there what used to be the Illinois State Building, which Google bought and found a use for. So I am curious as to whether there is an opportunity for non-traditional real estate players to maybe come in and find some value in some of those properties.
That's definitely been a big point of conversation for a lot of investors, is what types of other uses can these office buildings be converted to? The thing with that is it takes a long time for that to unfold, many years in many cases. There are some that are being looked at residential conversions. We've seen a few trades happen in New York where the investors are coming in, buying these offices for less than 50% of what they were priced at pre-pandemic and looking to convert them into residential uses. But in many cases, that's really hard to do, and zoning doesn't allow for it. It might be too big. It might not be conducive for the types of apartment sizes that are required to build these types of buildings. And then in other cases, we've seen offices being looked at, perhaps being converted to medical offices, life science, or industrial. But again, it really does come down to the physical aspects of the building, the engineering, and the costs, all of which are hard to make it work right now in this market, especially when financing is tough to secure.
Financing is tough to secure, but rates are falling and they're going to fall some more. So if the landlords have an opportunity to kind of keep extending the duration of their loans, that would help them, right?
That's the big question, is if they have the opportunity to keep extending. And they've already been extending for many years now. At the same time, their income hasn't risen in these buildings, and they're keeping up with rising costs to pay their debt, to pay the taxes, to manage the buildings. In many cases, a lot of these landlords just kind of want to cut their losses and walk away. We've already seen the biggest institutional investors like Brookfield, like Blackstone, walk away from big office skyscrapers that just a few years ago they spent millions to renovate. They walked away, handed back the keys to the lenders because they just want to cut their losses and put their money to good use and to other opportunities that are unfolding in this real estate market today.
All right, great stuff, Natalie. Going to have to leave it there. Natalie Wong over at Bloomberg, a closer look here at the commercial real estate market, the lack of people going to the office. Natalie Wong, of course, broadcasting in from home. I am curious about the conversion aspect, because they showed some buildings there that had been converted, including a couple in Illinois. The one that I stayed in that was basically turned into kind of a hotel, not every floor, but most of them. And then you had Google and Facebook roll into the city and buy up some buildings as well. So, I mean, there is a potential there if somebody can find, I guess, a low enough price to make it worth their while.
Right. But of course, you got to get policymakers on side too, right? They have to pass all the zoning laws or make exceptions for the zoning laws as well. And, that's all a matter of personnel. There's an election coming, so that factors in too.
You know what they can make them into? Costco's.
I'm there.
We're going to set you up for what to watch. This is Bloomberg. Let's get right to it. Here's what could potentially move the market over the next 24 hours. We start over in London at about 9 a.m. their time, about 4 a.m. our time.
Yeah, Hugh Pill will be speaking, and that'll be really interesting after the BOE Governor Andrew Bailey said that he's encouraged by the fact that inflation is not as persistent, and he's calling for more aggressive rate cuts.
Yeah, it'll be interesting. We got a comment from him, of course, generally considered to be a little bit more hawkish than Bailey, looking to see whether he toes the line. Back here in the U.S. at 8:30 a.m. Eastern, we do get that monthly jobs report for September.
And Louise Sheiner of the Brookings Institution was telling us the key number that everyone will be paying attention to is the unemployment rate, expected to stay unchanged at 4.2%.
We also are getting some Fed speak. Fed President Austin Goolsbee going to be sitting down with Michael McKee, and we're also going to hear from New York Fed President John Williams. We'll be back tomorrow. This is Bloomberg.